Hey everyone, it's Ben here, and today we're going to be talking about Costco. And this is a little bit different from previous videos or valuation videos I've done because typically I do DCFs for more tech companies because that's kind of where my natural interest lies. But I thought Costco would be an interesting company to analyze because they're going to be reporting earnings on Thursday after the market close. So I want to see if it's a good stock to buy based on the DCF analysis I'm about to do. And so going through today's agenda, I'm going to go through a Costco situation overview, then let you know a bit about today's sponsor, moomoo, then do the DCF, go through WACC and mid-year convention, kind of all part of the DCF. And then we'll talk about the price of what the model kind of says. And so first off, let's go through a situation overview for Costco. And so let's look at the stock and see how it's been doing. You can see that over the past over 2022, it's been relatively flat if you were to start from the beginning of the year until the end. And there's been some dips, most likely due to inflation and supply chain issues, all of that stuff. And then it's kind of recovered, but it's now on the downward trend as most stocks are. But if you actually zoom out, go like 5-year, you can see that the trend is very much upwards. Strong company with strong earnings. And if you go even further, it's like massive when you compare it to the beginning of when Costco was first public. So that's kind of the stock, but more qualitatively with the situation and what's going on, there's kind of 3 bull cases that are important to be aware of. So first, Costco typically has increased their membership every 5 years, and the last one was in June 2017. So we're kind of about that time where Costco might raise membership again. And if you know anything about the company, you know that Costco doesn't really make that much money on the margins from selling each product, but instead on the membership fees that it sells to all of its members, right? So increasing that membership fee is kind of like Amazon increasing their Amazon Prime fee. It can make a pretty significant difference. And so that's something to keep note of. And then there's also the kind of competitive pressure that Sam's Club recently increased their membership fee the first time in 9 years. So something of note there. And then overall, Costco is generally launching 20 new clubs each year, and there's solid customer traffic, steady membership renewal rates. Like once you live in an area, especially if you're kind of like more, I don't know, like a family, once you have a Costco membership and you start shopping there, there's really no going back. And anyone who's experienced shopping at Costco kind of knows what that means or what that feels like. And then solid international growth prospects. Even when I was living in Korea for the past few years, right now I'm back in the US. Just went to Costco last week, actually, which kind of is why I was interested in doing this DCF. And when I was living in Korea, there was a Costco nearby, and I would go there all the time as well. So there's a lot of potential growth with Costco kind of just growing internationally. And then what is the bear case? Adverse macro shocks, inflation pressure, supply chain issues. These are all things that affect every company, but Costco in particular could be a plus or minus, right? Depending on how you look at it. With inflation pressures, food increases in price, so it may lead to people purchasing less of more expensive items. But also, if you go to Costco, you get the biggest discount, right? If you buy in bulk and are able to eat everything that you buy. So could be plus or minus. E-commerce disruption, I do think this is pretty important. So companies like Amazon, where discounts or where it's increasingly getting easier to purchase things one-off for pretty cheap prices on Amazon and other kind of e-commerce companies, that's definitely a significant pressure for Costco that it will probably have to fend off for many years to come. And then there's a potential risk of things reverting back to pre-COVID levels where we had less at-home consumption and people were going out more, things like that. So that's kind of the bear case. So that's basically the situation overview, very high level for Costco. And a few reminders before we jump into the rest of the agenda for what we have today. First off, this is a high-level street-based DCF I'm going to be making. So normally for a DCF, you want to have a lot of research backing every single assumption, but as retail investors, it's tough to have all access to all the resources and the time, really, because we typically normally have other full-time jobs, like I'm going to school right now. So a street-based DCF is great to have like a baseline, and then you can if you make your model dynamic and have switches, then you can have ranges for your conservative and optimistic case, which is what we're going to do today. And so Friendly reminder, this is not financial advice, just for educational purposes. And like you can take my thoughts however you want and then apply them to your own research. And a few other things. I am creating an investment banking recruiting course in case any of you guys are interested. Feel free to check that out. I also have financial statement tutorials that I created recently that you can check out in my description. I have Excel shortcut and DCF tutorials as well. So if you're new to finance, feel free to check any of that out. So with that said, the second thing I wanted to go into is our sponsor for today, which is moomoo. And let me walk you through. Well, first of all, they are offering something that most of my sponsors, I've not seen for any of my other like brokerage sponsorship partnerships before. They're offering up to 15 free stocks, and we'll kind of go into what that requires later. But I wanted to go through Costco a little bit, what it looks like. You can see that they offer a lot more financial information than pretty much anything you'll see. You can also see a bunch of news from any company. Look at the analysis. And I thought one thing that was really interesting here was the analyst rating, which is kind of hard to get otherwise. Then if you go to the financial tab, you can see a bunch of different financial metrics. Whatever you want for any of the financial statements, it pretty much has the information. And lastly, for summary, one thing I wanted to point out that I thought was interesting is you can look at shareholder holdings and see what kind of firms are. Oh, oops, you can see I was listening to Blackpink earlier. That wasn't supposed to be part of this presentation. But anyway, so yeah, feel free to check them out. There's $0 in trading fees. You can get up to 15 free stocks. A few more kind of pieces of information about them is that they offer free level 2 data. So what this level 2 is it shows you who the market participants are that are making a trade, what they're buying or selling, the size of the order, and the price offered. So if, let's say, I don't know, BlackRock or some other, or a hedge fund or something was purchasing stock of Costco, you can kind of see what they're buying at what price, the size of the order. Other brokerages like Robinhood charge $5 a month, Weeble's $2 a month, moomoo's free if you get an approved account. And then they also offer 24-hour support, either by calling or email or chat. And so that's pretty important in case, you ever get into a bind with something with your account, then you can always contact them, which is pretty important. Not every brokerage will offer something like this. And so if you do want to get up to 15 stocks, I believe you have to deposit up to $2,000. And there's no other restriction besides that. So if it's something like if you deposit $100, $200, you get 3 to 5 stocks. And the more you deposit in cash, then you can get up to 15 free stocks, which is just like crazy. I would definitely do this, but I can't refer myself. And so feel free to check them out in my linked comment down below. So, yep, that is moomoo. And then let's go into building our DCF now. So I pulled in all the information that we're pretty much going to need here. And so the DCF that I'm going to build today, other times, like if you saw my Apple DCF, that one had a revenue build. For Costco, things are going to be a little bit more high level because the company is so mature. And I think I don't know for sure yet, but by looking at just historicals and what the street thinks, I think we're going to be able to have like pretty steady numbers such that we can just build out a 5-year DCF instead of something like a 10-year DCF. And I think the historical figures will be kind of reliable when we combine it with street estimates to predict the next 5 years. So let's just start populating some of the things that we need here. So I see a question. As I go through the DCF, I'll try to answer some of your guys' questions and comments in the chat. And I see something about what factors do you look at when not using street assumptions? So you're working on the NVIDIA DCF. Yeah, I think when you don't have street assumptions that predict into the future, you're gonna probably want to rely on historicals a lot more. Or you have to. You don't really have much of a choice. I mean, that's a pretty hard question. I think it's pretty hard to build or predict into the future if you don't really have reliable ways to create your assumptions. So you're gonna have to do research maybe looking at like industry reports about semiconductors for NVIDIA's case. Try to see where the industry is growing at and what you think NVIDIA's growth rate is going to be in relation to the industry growth. So, for example, if you think the industry growth, if the semiconductor industry growth is predicted to be 5% CAGR for the next 5-10 years, if you think NVIDIA is going to be at a 1.5 times multiple of that, then 7.5% CAGR, then you can kind of triangulate to your growth rate for revenue for something like that. For margin, I would just look at history, like EBIT margin. Either keep it steady or grow it, because if there's a history of growing EBIT margins, it's likely that the company will continue growing or like improving its margins, but at some point it'll probably be relatively flat. Okay, so DCF, we're gonna need assumptions. We're gonna need our income statement items here, then cash flow items. Then we're gonna build out our DCF. So let's see. Our figures start from 2013, so that's where we will start. And I think we're just gonna build out a 5-year DCF. So 2022, since we only have a few months left, I guess it'll be kind of a 6-year DCF. Oops, I didn't mean to have that in there. Okay. All right, just setting things up right now. I go through a lot of the shortcuts I'm using right now on in my Excel shortcut video, in case you guys are wondering what shortcuts I'm using. And I also am planning to make another shortcut video that goes into other things. So if you watch that first one, then stay tuned for more. I also see a question, is there a free site to quickly pull all the financials for Costco or any company? There's one called Wallmine that I used in the past. Like it's WLLMINE.com. Ticker, I think, is another one, but I don't think that one's free. BAMSEC.com. But usually that's just for the past few years. All right. So income statement, what we're going to need is our revenue and our percent growth. And then our EBIT. Also, let's do a quick poll before we get to any figures. Do you guys think Costco is a buy or a sell? Let me know in the chats. Yeah, I guess it could be a hold too. Oh, interesting. We have a buy, hold, and sell so far. A lot of people surprisingly pretty bearish. All right. So let's see. We will start off by just linking to our income statement. So we have our sales here, total revenues. What is net sales? I'm pretty sure we should just be pulling from here. But let me just double check with the actual filing. So someone asked about like where to pull figures from. Well, actually, these are all calendarized. Get an approximation. So let's just go to 2021. So Costco actually ends their revenue or ends their financial statements in August, end of August. So basically beginning of September. So yeah, we can see net sales and membership fees. So we can work off of total revenue. That's pretty much what we should be using. Makes sense. Calculate percent growth. All right, so we have our revenue. Just quickly looking at the percent growth. Over the past few years, there's been a huge increase, maybe due to COVID, and over the next few years, things will start normalizing, coming back down. But for a company like Costco's size, this is like pretty solid growth. So EBIT stands for your earnings before interest and taxes, also known as your operating income. It looks like there is GAAP versus non-GAAP. What the differences look like. And your GAAP is larger than your non. All right, but not going to complicate things too much. Just going to use our GAAP figure for now. While I'm like doing all this kind of mindless stuff by really just pulling figures, I'm curious to know if you guys have any like video requests, like types of videos that you guys want to see. Let me know in the chats, and I'll take a look at them. So EBIT margins are very, very low, and that's not super surprising based on how Costco seems to report its earnings and its revenue, right? So as I mentioned at the start of the video, or maybe looking at their financial statement is better. So what Costco really makes their money on are the membership fees, which are essentially, in a sense, like not 100% margin, but that's what they really just make their money off of. And you can see that their net sales, which is like what you pay, what everyone pays at the cash register when you're buying at Costco, that number is really high, but their merchandise cost is really high, which can be assumed based on this is the cost of actually purchasing all the inventory and all that, right? And then you also have to spend on employees and everything. So what they're really making their money off of is this membership fee here. Or that's the general model for Costco. So that's why, for other companies, you might see like a margin that's, in the 20%, 30%. You'll never see that with Costco. All right, next with taxes. Yes, I do think that an LBO model or an LBO model is in the works. To be 100% honest, I did do an LBO model or a few of them when I was at JP Morgan, but it's been a while and I forgot. I need to brush up a little bit. So once I have the time to brush up, right now I'm also at school getting my MBA, and it's been quite a busy schedule. So once I make the time to do that, then I will definitely make the LBO video because I know a lot of you guys have requested that. All right, so okay, so for our cash flow statement, we need depreciation and amortization. Then we need capital expenditures. Then change in net working capital. So this will be, there are going to be multiple ways that we look at D&A and net working capital. So first one is going to be percentage of sales for D&A. Also for change in net working capital. And then the next thing we're going to do for D&A is look at it as a percentage of capital expenditures. because the D&A and capital expenditures should have a relationship with one another. D&A should eventually converge to where CapEx is. Then for net working capital, let's also look at change in sales. All right. So D&A, let's find where our D&A is. So okay, so for whatever reason for FactSet, I couldn't get the historical figures calendarized, so I'm gonna need to do that. And in case you don't know what calendarization is, it's simply just converting all these financial figures to December year end instead of keeping it at September year end, so that it's consistent with the rest of the financial metrics, right, which are December year end. So for Costco, since they pretty much end at the end of August, that leaves September, October, November, December, 4 months. So 4 divided by 12, that's how many months are left, and then the rest is 1 minus this. So in order to calculate the calendarized, and this is kind of more of an approximation, it's not a really perfect metric when you calendarize, because the actual, let's say, revenue that you earn in a particular year changes a lot, right? So for 2013, what we want to do is we want to take essentially a third of 2012 and then take 2/3 of 2013. Wait, is that right? Let's see. No. Okay, wait. We can't get 20. For 2013, we need to take 1/3. Think about this. 1/3 of August, or sorry, 1/3 of 2014, and then so let's see, 1/3, and then multiply by 2014. So we're taking a third of what's in 2014. Yeah, and then I kind of did this out of order, but but anyway, 2/3 of 2013. Yeah, that's right. So essentially what this is doing, and I did it out of order, so it's a little bit confusing. So let me change these a little bit. So we're taking a third of the months in August. So we're essentially just trying to take the beginning, or since this starts in September 2013 to September 2014, we're trying to take a third of the remaining months from this fiscal year. So we're trying to get, in a sense, September, October, November, December from this fiscal year, multiplying it by our figure. And then we're also trying to get 2/3 of our previous fiscal year. So January to September of 2013, or August, end of August. So that's pretty much what calendarization is. And since I linked everything like that, we should be able to just multiply across. The only thing we really need from all of this is depreciation and amortization. Not linked correctly. Oh. All right. So now we have our depreciation forecast, or for historicals. Okay. So I see a question. What happens if I don't calendarize and just keep the projections at August 31st? So you can create a DCF that is all based on fiscal year, right? But the only issue is right now, our figures are based off calendar year, ending December, right? And that's usually how you want to build your model. Well, actually, it depends on the situation, but generally, it's just easier to think of things as of the end of December as opposed to like August or some random month. So it depends on how you're building everything, but for our purposes, we're building it as of December year end, so we want to make everything consistent. So I'll just add a notation here. Make sure that we're all on the same page. All right. So depreciation and amortization, we don't have 2013, but we do have starting from 2014. Oh, we do have 2013. All right. And I'm also going to add a line from when our projections start, which is in 2022. Okay. So then we go to, I also pulled some of the estimates for depreciation from FactSet here. Let me actually double check if this is based off of calendar or fiscal year end. I'm just reading some comments. Okay, so you guys also want to see a 3-statement model, which I will definitely do in the future as well. Cool. So let's see. Just a little bit odd to me that depreciation amortization jumps so much as well. We need to change this. Calendarized, time weighted annually. Really changed much. Hmm. All right. So let's see what happened here. Okay, so I need to take it from that year. Written annually. Okay, so 1930. Okay, so it actually went up a little bit. Exit usually computer lag a little bit. Exit out. I have like streaming going on and like Excel and like a few other things, so that's why. All right, so let me refresh this data here. Okay, so here are now our estimates. Okay, so things are not as weird as I thought actually. It's just that 2021 was an odd year because you can see in 2020 we were around 1700, fell for not sure exactly why. Maybe it's something related, probably related to COVID. Okay, so then let's get next our capital expenditures. And then change in net working capital, which we'll have to forecast ourselves. But we do have our historicals that we also need to calendarize actually. That can be found in our cash flow statement here. And Costco is a very, very efficient business. You know, they have to be in order to make money. I mean, every business does, but some companies are in like growth stage. Like Costco is definitely one of those mature companies that has mastered their entire model. So don't expect working capital to be a huge part of our model. Like it should be close to zero. All right, so let's see what our figures are showing. But before that, I do want to copy the formatting. Don't have to do it again later. All right, so percent of sales. By the way, I know from at the beginning of this, some people were saying like this was your first first stream that you joined and everything. I stream very randomly. It's like, well, there's some level of, oops. Let me make sure I did this. Yeah. So there's some level of pattern where I usually stream when there's a lot of earnings coming out. But I didn't post on my Instagram that I'd be streaming, but I will try to do that more often so that in case you guys do want to join and want to know my schedule, I'll post on my Instagram stories about it. And I should probably also post on YouTube. So I'll try to do that as well. As I'm working through all this, let me know in the chat where you guys are from. I'm pretty curious to know. And as you guys type that out, I'll also kind of provide some comments on what I'm seeing here. So we kind of went through margins, growth already, taxes, is pretty standard around 20-something%. Depreciation and amortization has been pretty steady, around 1% of sales, and that's what's also predicted for the future. Capital expenditures, around 2%, maybe a little less, but pretty steady. Change in working capital, less than 1% of sales. Percent change in sales, it is a little bit wonky, so we'll probably rely on our percent of sales. That's why we're kind of looking at multiple different options just to see if there's something that's a little bit more reliable for when we're projecting out into the future. And then another thing I do want to check is for our estimates, the years that are closer into the future, closer to the present, are much more reliable because it's it's easier to project out things correctly 1 year from now versus, let's say, 10 years from now, right? And that's also true for these years that are few year out. And another thing that happens is not every analyst will project out for the next few years. Some will only project out like 2 years, some will do 3 years, etc. So let's take a look at where the analysts start to drop off. The depreciation looks like starting August 2024, 2025. So it looks like 2022 and 2023 will be the most like reliable, and then everything 2024 onwards is going to be a little bit unreliable. So we might have to just make our own projections. I'm just going to add that, note that with the highlights here so that I don't forget. And with that, we're ready to build out the DCF. And we're going to use pretty much everything that we've pulled. Since we don't have like a revenue build or anything like that, this should be a pretty simple DCF to build out. And I think the capital structure for Costco will also be pretty straightforward. So calculating our WACC shouldn't be too hard either. And as a friendly reminder, if you joined a little bit late and if all of this is new to you, I mentioned earlier on in the video that there's a DCF tutorial, there's like financial statement tutorials on videos that I made pretty recently. So feel free to check those out if you'd like. For those tutorials, by the way, I include free Excel documents that you can use to like follow along as I like go through everything. So yeah, check those out if you're interested and want to learn. But with that, let's what to do here. So we don't really need, well, yeah, I'm just gonna link to the historicals. So starting off with revenue, And I'm going to use a color code purple for, okay. Purple, so these are just color codes to make it easier to later look at your model and see where all the numbers are coming from. Purple just means it's linking to the same sheet, which it is right here. All right, so just taking a break and looking at the chat. Seems like, oh, you guys are from all over the place. Okay. So, got our revenue, historicals. And then now what we're going to want to do is, oh, I could just take it from up here. We're going to build out our different cases. All right, so we have our our conservative case, our street or base case, and then we'll have our optimistic case. Okay. So the way we're going to do this, similar to before, and to save some time, I'm going to actually pull from my previous model that I built and take the formatting from there. So I'll delete everything here for now. Okay. Oops. All right. So let's take a look and now try to think about how we should project out our revenue, which is one of the most important parts of the whole analysis. Revenue and EBIT margins is really going to be what drives our entire model for Costco, because everything else, like the cash flow items, are pretty steady. So we really want to focus a lot of our energy and efforts on projecting these out well into the future. So, oops. Fix this. Okay, so I see a question about interest. For DCFs, you build out with your unlevered free cash flow, and that means that your cash flow should be available to all shareholders. And so you don't want to subtract out interest. Okay, so generally speaking, what I like to do is not worry too much about 2022. There's only a few months left, and analysts should be able to predict the next year pretty reliably. So for 2022, just kind of keep it at what the street thinks, and then do that for the first year for both our could reduce it a little bit. No, to make things pretty simple, there's only a few months left in 2022, right? So I don't think the analysts are going to be to above or below 2022. So we're not going to worry about that. But starting from 2023 onwards, that's where we want to have a little bit more judgment. Right. So historically, we can see that Costco has been growing in terms of sales roughly anywhere from as low as 3% all the way up to 16%. Remember what we talked about here in the bull case earlier on? Costco is considering, or it could be considering, increasing its membership fee like it did every 5 years. It also has some competitive pressure with Sam's Club, which made its first increase recently, first in 9 years. And also with inflation going up, Costco, they might be thinking, hey, like everything's going up in price. Customers may be willing to also understand us increasing membership fees. So that could be some of the thinking going on. Who knows exactly what's happening? But I think for 2023, we can also rely on the street case for our base case. And then we'll kind of make things a little bit more conservative or optimistic, depending on what we think here. But to finish out our base case, we can see that the street, though this is pretty unreliable, thinks that it'll grow. Revenue growth will kind of slow down to somewhere around 3 to 4% in the next, let's call it 5 years or so. I think given that Costco has been able to pretty significantly maintain its growth, something that'd be relatively conservative, though while still being in our street case, is like growing down growth to 3% from our 8%. I would say that's a little bit on the conservative side, but we want to be conservative with our models, generally speaking, or that's my approach. So that's what we're going to do. We're going to have it be 3% for 2027. Okay. Sorry, I was looking at the chat. Take a look at my DCF tutorial video. That might answer some of your questions. Interest should not be part, while interest is important, it's really not a part of a DCF when you're using unlevered free cash flow, because for unlevered free cash flow, you're thinking about the core business, how much cash flow can it generate? And you can use that cash to pay off debt if you'd like, but it's not really what you want to, interest is not really what you need to focus on for DCF. So we're going to linearly just grow this down. So growing from 8.6%, 7%, 6%, 4%, 3%, that seems pretty reasonable to me. And then for 2023, so if we're being conservative of the 8.6%, let's call it something like 90%. And then if we're being optimistic, let's call it 110% of our 2023 figure. So that is 2023. And then for 2027, I think if we grow this down to, who knows, maybe there's more e-commerce pressure. If we're being super conservative, I think growing this down to 1%, which has not really happened in the entire history for Costco, right? But as revenue grows more and more, it grows harder to have like a higher growth rate. So, it's not outside of the realm of possibility for 1% there. And then for our optimistic case, let's call it something like 5%. Okay, so 1% there, 5% here. And later on, when we look at the price and everything, it's going to be a range. So we'll kind of take a look at what the ranges tell us based on what we believe. That'll probably be about like 30 minutes or so. Okay, so we now have our conservative case. Now look at our optimistic case. And we're going to want to make everything dynamic by just using switches. So what this simply is we're going to use our offset function, reference our cell, then go to our switch, is right here. Press F4 to anchor it, 0 for columns. And we're going to need to add the number like 1 here. Cool. So what this will do is whenever we make the switch, whenever we change the switch, it'll change our assumptions that we're plugging in. So get 1 plus our growth rate to get our revenue. This black because it's being calculated. All right. So now we're done with revenue. I think this is pretty fair. I would think, just looking at this so far, I would probably look at the range for our base to optimistic case. I think given Costco's like strength in management and just historical kind of figures where the company has been able to do pretty well, I would more lean towards the street to optimistic case. If you're a bit more pessimistic about Costco, though, you use the conservative case here. All right. Next up, let's go to percentage of sales. Do the same thing here. Okay, so EBIT as percentage of sales. So we're going to do something similar for 2022. Just kind of rely on what the street is giving us. Not worry about that too much. And then for the rest of the years, that's where we're going to have to do a little bit more thinking. So we can see that historically the margins have been around 2 point, it's been growing from 2.9% to 3.5%. And the street roughly thinks it'll be around 4 point something percent. Although these numbers aren't, again, not super reliable. But, if we were to, let's say the max is 4.4%, or not the max, but max for our street case, I think, let's see what the average here is. 4.2%. Yeah, I think that's roughly fair given the figures that we have here. And we can be a bit more optimistic or conservative in our assumptions later. So for our base case, 4.2%, I'm thinking I'll do conservative and optimistic later. So let's link to our 2027, and we're going to do something very similar again. But instead, this time, instead of growing our revenue down, we're going to be increasing our margin. So we want to plus the difference between our 2027 figure and our 2023, divide by our number of years. Cool. We have our figures now we have our margin for our street case, base case. And do something similar again for 2023 and for 2023, 90% here, 110% here. These are pretty significant increases, actually. Wait, 3.6 to 3.3%. It seems a little bit too aggressive. So both aggressive and in both ways. And so let's make it a little bit just closer to the normal figures or the 2023 projected figure. Okay, and then for our optimistic case, I think if we were at 4.5%, that sounds pretty optimistic. And then on the conservative side, historically around 3 point something percent. So then I think if Costco were to just stay flat, actually, I don't see their margins decreasing. But if it were to stay flat, I think that'd be pretty conservative. So yeah, but let's have it grow a little bit to something like 3.7%. Whoa. All right, keep pressing my keyboard button. Okay. So let's again link to our, I switch these, 0.7%, 0.5%. A conservative case is a lot more conservative. And what I mean is that's a 0.5% decrease versus a 0.3% increase. I think starting off at 3.5 to 3.7 is 0.2% increase, 3.9, 6%. Okay, so I guess to make things a little bit more even, let's just keep it kind of equal at 0.3% differences. I do think that, let's say you are Costco management, you would not want your margins to only increase by 0.3% in over the course of 5 years, right? So I do think this is conservative enough. Okay. Down now. All right, so we got the hard part done pretty much. Revenue and EBIT, pretty much like the entire, or not the entire model, but a lot of it. We'll have our switches here. We'll do the same thing. Goes offset, reference the current cell, and go to your switch. All right, as I do this in the chat, who's been here since the beginning? Just out of curiosity. Okay, so we got our margins. All right, so now taxes. I don't think I'm going to sensitize for this and make it dynamic because it looks pretty steady. I mean, you could always model for changes in like, you might want to actually sensitize it if you think that tax rates will change in the future, of course. But me personally, based on what we're doing here, it looks like things are going to be around 25, 26%, right? So for our tax rate, I'm just going to assume that things stay pretty steady at around 25.5%. A bit of a shortcut. Okay, let's do an average of the next 2 years. Are reliable. All right. Looks like Nicholas and Richard, you guys are the MVPs for today. All right, so we got our taxes. Pretty simple, right? We're just gonna get our average. Not worry too much about this assumption because you can't really predict how taxes are gonna change unless you have like some insight into the government and what's gonna happen with policies. So EBIT minus taxes is your EBIT or net operating profit after taxes. Oh, and Cicero. Oh, that's a cool name. Thank you also for being here since the beginning. Okay, so now we're going to look at depreciation and amortization. So what I'm going to do now is hide the income statement part that you guys can see everything else. Then let's open up the cash flow items. I also have a class in 30 minutes, so I'm going to try to finish this model in the next 30 minutes. So depreciation, amortization as a percentage of sales. All right, so depreciation amortization around 1% seems like what it's been historically. And 0.6% super odd because of 2021 or because of COVID, it seems like. If we look at what the street projects, they think around 0.8%. And I'm just going to go with that. Didn't really affect our analysis too much. But it is important, right? You do want to make sure that your assumptions are based on something and reasonable. So, and I think this is. All right. So we do have our depreciation and amortization. Now we need our CapEx. As I stated earlier on, this is the good thing about Costco. Their numbers are pretty easy to predict out or forecast based on historicals and street estimates. The class I have, so right now I'm pursuing an MBA at the same while I manage rare liquid stuff, and I have a Korean class. Yeah, I have to take Korean class because I'm part of like dual degree thing, which with international studies. And as part of that, I have to like learn more of my language track that I'm in, which is Korean. I actually have a careers channel, in case you guys didn't know, called Rare Liquid Careers, and I go over like MBA stuff, banking stuff, interview like my classmates and stuff like that. So feel free to check that out if you're interested. But it looks like the street thinks that CapEx is going to be around 1.7%. So that's what I'm just going to use as well. And then let's look at change in net working capital. This one is, I guess, a little bit tricky. So it's used to be around 0%. Now it's gone anywhere from 0 to 1.3%. What I'm gonna do here is take an average over the last 5 years. Given how steady Costco is, I think that's the best way to do it. 0.7% sounds pretty fair to me. All right, cool. So we pretty much have everything we need to for our cash flow. Of course, we're going to need to calculate our WACC. So unlevered free cash flow is simply our EBIT, or earnings before interest and after taxes, also known as your NOPAT, net operating profit after taxes, plus our depreciation and amortization, minus our capital expenditures, minus our change in net working capital. Okay, so now we have our cash flow figures. Then what we want to do from there is find our present value of free cash flow. And then we want to add cash. Add cash. Subtract debt. Oh, sorry, I skipped a few steps. So ultimately what we're going to do is calculate our enterprise. So terminal value. And then we're going to need our present value of terminal value. Then we get to our enterprise value. And after that is where we add cash, subtract debt. Gets us to our equity value. And we get our number of shares. Gets us to our price per share. All right. So to get to our present value of free cash flow, we're going to have to calculate our WACC. Create a new sheet for that. I'm going to take a shortcut again and pull from a previous model that I built. So just for a review, in case you guys are not familiar with WACC, the discount rate that takes into account both cost of equity and cost of debt. Sounds really complicated, or looks complicated if you just look at the formula, but simply what you're really just doing is getting your percentage of equity in a company, multiplying it times your cost of equity, which we will calculate using our CAPM formula, which is your risk-free rate plus beta time market risk premium. Then you add your percentage of debt of the company times your cost of debt, which is usually just like your interest rate, times 1 minus your tax rate. And let's go through all of that here. It should be a little bit more easy to understand once we go through this together. Okay. So market cap, first of all, let's just go see what Costco is trading at. So market cap 221.3 billion. Risk-free rate, let's see. 10-year treasury yield is usually what we use. Yeah, so I see a few questions that kind of interesting. What's been my favorite course at Wharton so far? Am I going to pursue a 10-year, sorry, I was about to say 10-year treasury yield. Am I going to pursue a CFA? I don't think so. I know some people who do CFAs and find value in it, like learning about everything, and it does provide some level of ethos and credibility. But personally, I personally don't see a ton of value of what it would add to my career. So that's why I'm not going to do the CFA. And so my favorite course at Wharton actually has been a course on valuation. And later on, if I learn like some kind of model, if there's like a model that I build that has very different methodology, then I'll make a video about that for sure. Right now, it's kind of only been a few weeks, and so kind of been a little bit more review. And then I see a question on perpetuity versus growth method versus exit multiple method. You know, in practice, I think it's good to do both and then take an average of the two. Besides that, it can be also based on preference. Like I just prefer to use the perpetuity growth method. It's kind of based on training at JP Morgan. That's usually, at least in the healthcare group, that's what we normally just did. We just use the perpetuity growth method. I think either is pretty valid. It's based kind of just more on style. So anyway, 10-year treasury yield. So this is essentially what you could invest into a government bond backed by the US and pretty much guarantee that you'll receive this money, right? So 3.548%. Also look for Costco's beta. I think will be relatively low. Oh, another reason though, you might want to use your perpetuity growth method instead of your exit multiple method is if your exit multiple, you don't have a pure set of companies that are reliable, or if your EBITDA is not reliable when you project that out. Those could be some reasons why you prefer to use the perpetuity growth method. All right, so beta was 1.1. Market risk premium. I'm gonna have to find this. Investor, I always forget his name. Oh, okay. It up before. Equity risk premiums. But last time I looked at this, it was a little outdated, I think. Where is this from? No, this is like January 5th. I know there is an updated figure somewhere. I always forget where it is. Okay, you know what? In my previous video, it was 6.01%. We're going to just use that. It might be off a little bit, but well. Okay, so Costco, let's now look at its debt. I have no idea if the company has any debt actually. Let's see. Current portion of long-term debt is 77 million. So equals 0.077 plus long-term debt, which is 6.5 billion. 6.507. So not that much. Oops. Should be number. So most of the WACC is going to be based on cost of equity. All right, so cost of debt. See if they break out their interest payments here. Interest expense. Okay, interest expense 35. Earnings before taxes. Okay. So expense is 35, and I think if we were to be able to divide that by okay. Let me just think about this if it's correct. What are they paying? Let's see what they're in. There's more data here. Okay. Okay, so they pay somewhere around 1.75% to 2.3%. If we calculate using our interest expense and divide by our EBIT, then we get roughly, and this is what we're going to use for cost of debt, because they have a bunch of tranches for debt, but we don't really know exactly, or we have the weight of all of them, but we don't know exactly how much they paid off and what they're paying off for interest rates. So we're using a blended interest rate essentially. Taxes, you can pull from our tax rate. I'm just going to pull it from here. Oh, I see someone that says differential 2022. All right, so let's Google that. Differential 2022, July Damodaran. This is a New York professor who publishes equity risk premiums. United States. ERP, equity risk premiums per country. I think it should be here. Total equity risk premium. Okay, let's see what this looks like for the US. Okay, 6.01%. Cool. So we're using the right figure. All right, so with all that said, it gets us to a WACC of 9.9%, 10%, which is a little bit higher than what I thought we would get at, to be honest. But this is what the data gives us. All right, so that is going to be our street/base case. Man, I have 10 minutes before my class. I have to kind of hurry up. And then for our conservative case, I'm going to decrease this by 0.5%. For our optimistic case, increase it by 0.5%. Terminal growth rate, keep it pretty steady at pretty just standard at 2.5%. 2% for terminal growth rate here. And then we use our choose function. All right. So next up, we're just going to have to discount to present value. Let me actually message my friend real quick because I need my class thing is something that's like a one-on-one thing, and I want to see if I can switch with one of my friends to extend this by 30 minutes. Okay. Hopefully they can switch with me. Either way, I have to finish this video. So, all right. So another thing that you can do when you're building out models, you can actually name your cells, and so it's easier to use. So we're gonna call this WACC. We're gonna call this TGR. If we do that, what we can do here is actually we also need to do mid-year convention. Figure out our discount rate. Okay, so for year here, typically, so what I'm trying to do right now here is, one sec, my friend messaged me. All right, so I successfully switched, so now I have time. All right, so discount rate, let's see. So the thing is that, so okay, first of all, mid-year convention, typically when you're discounting back, if you use the discount period of 1, then that fully discounts everything back by 1 full year, right? And the reason that you don't necessarily want to do that is because when you receive your cash, it's not at the end of each year. It's throughout every single day you're receiving cash from the business. So what mid-year convention is it's a really simplifying and also simple kind of like modeling task. I don't know. But instead of assuming that all the cash comes at the end of the year, you're just assuming that it comes in the middle of the year. So end of June, if you're at a calendar year end. And so maybe this will be a little bit more crystal clear if once I start doing this. So the tricky thing with 2022 is that we're not looking to discount back the entire 2022 or the full year of the free cash flow, right? Because when you're creating a DCF, it's really only into the future, and you shouldn't be looking at like anything historical when you're projecting out your cash flow and you're getting to your ultimately to your enterprise value, right? You're projecting out the next 5 years. You're not using any historical figures to get to your enterprise value. So with all that said, one thing that we need to do is calculate here, how many days are left in the year. The days left in 2022. We're going to use a formula called year frac. So year frac start date is here, 9/21/2022, and end date is 12/31/2022. So there's 122 days left in the year. And if we divide this by 365, percentage, we have 34% of the year left, basically. And what we're gonna do for our first year's discount rate here is get our 1 year, multiply by the amount left. So this is our discount period left in a sense. And then we want to divide this by 2. So essentially, once we get our free cash flow figure here and we discount it by this 0.17, we're only discounting it, the entire 2022 figure, by 0.17 instead of 1 full year. So I know this kind of, I don't know, this, if I heard this for the first time, that would be really like hard to understand, but this is kind of a little bit, I wouldn't say I'd call it super advanced, but I'd call it like a middle intermediate level concept. And maybe I should make a video about mid-year convention so that I can link to it in the future so I don't have to explain it every time. But yeah, I'll put that on the list of things to do. And then for the second year, instead of having it 2 years out into the future, what we want to do is have it be, let me think here. So from as of today, we want it to be the full remaining 2022 plus 0.5. That'll get us to June of 2023. So actually, I'm going to change this to a number. So we're going to do this plus 0.5. That gets us to June of 2023. And then for the rest of the years, we're going to just add 1. And that's the half. That gets us to the June of each preceding year. So now we have our discount. Oops, this should be discount period. And the reason we're dividing this by 2 is because we want it in the middle of the remaining time left in 2022. So essentially what this is saying is we want to get our cash flow not at the end of 2022, but in the middle of the time from today, which is September 21st, 2022, and December. So this will get us to somewhere around early November or so. That's when our cash flow, when we're getting our cash flow. So what we're going to have to do now is get our present value of our free cash flow. So that is our free cash flow divided by 1 plus our WACC to the power of our discount period. But also for this first year, another thing we need to do is that we don't want to take the entire free cash flow left, right? Because we only have a few months left of this free cash flow that we're actually projecting. So we actually want to multiply this by the remaining amount of days that we have left in the year, which is 34%. Right, so $799 for this first year, and then the rest of the years is pretty simple. So 1 plus our WACC to the power of our discount period. Then everything else we can now just copy paste across. Okay, so just to kind of explain what I meant by the whole like getting the cash in the middle of the year, let me just show you like what it would look like. So right now, just to compare, we have these figures here, right? If we were to not discount it using our mid-year convention and just do it by the end of the year, we'll get much lower figures. And the reason for this is if you look at this formula, we're dividing by 1 plus our WACC and going to the power of our discount period, right? So if we're discounting to 2 or 3 or 4, 6, or like a million, then our denominator is getting a lot bigger. And so our number or our free cash flow is going to decrease exponentially. And so that's why, this part is actually pretty important. And so let's revert it back to what we had before. Okay, so now we have our present value of our free cash flow. Next, let's calculate our terminal value, which is your last year's free cash flow times 1 plus your terminal growth rate, all divided by your WACC minus your terminal growth rate. That gets you to your terminal value. And then we have to discount this also to the last projected period. All right, we are pretty much there at this point. So our enterprise value is our present value of our free cash flow plus our terminal value is way lower than I thought it would be. But look at spinning. Okay. Costco. Okay, so there's maybe some things I'm gonna need to fix, but anyway, let's complete everything here. So 446.5 shares. Cash, pull from the balance sheet. $1,193 plus our short-term investment 638. That we pulled earlier for our WACC. Okay, so our equity value would be our enterprise value plus cash minus debt. Okay, so then our price per share, $91, which something is super, super off right now because, oh, this is so odd because Costco is around like 500. There's no way that Costco is trading this much at a premium. I think that I did something wrong, but here's what that would be. Cash flow figures do seem pretty low. Going on here. Fine. So usually when I do these DCFs, the figure that I get to is usually roughly similar to what the company's trading at. This is like way too off. Terminal values. Last year's free cash flow plus 1 plus the terminal growth rate, all divided by WACC minus your terminal growth rate. Right. Our WACC is pretty low compared to FactSet, but I don't really know if that'd make a big difference. Let's call this 0.5. It would make a big difference, but enough. Could be that our EBIT figures are too low, or our margin. So let's see, other income, operating income for company was at 1.791. Multiply that by 4. So our EBIT's roughly correct. Taxes definitely correct. D&A, CapEx. Okay, well, I mean, I guess it doesn't seem like I really did anything egregiously wrong, and all these figures are based off the company's historicals, so I guess this is where the price discussion will come in. So, oh wait, sorry, everything is in conservative mode. Yeah. Okay. So let's talk about what the model is saying, because I don't think I really did anything wrong. Costco price, implied price versus current price. The implied price down here at 113.58, and the company's current price is at 501.77. So, I mean, that's a huge difference. This implies implied upside versus downside. That is our current, or implied divided by our current minus 1. Okay, so, all right, this feels odd to me. Even in our most optimistic scenario, 161. This feels weird. What I'm seeing right now, though, is this is a company that's generating around $6 billion in cash a year. And for it to be valued at 200 something billion, kind of like the company is not generating that much cash, and it's not like the company is going to see huge exponential growth in the future. Let's look at its operating cash and its cash flow statement. Cash provided by, okay, so roughly 5 billion this year. Okay, so that's roughly 20 billion in 36. Okay, so yeah. So cash flow for 36 weeks, so that's 3 quarters, was about 5 billion when you look at net cash provided from operating activities. Which is kind of in line with what we get for our EBIT. If you then I guess if you subtract out your capex, instant plant property and equipment 2.6. Yeah, so I don't feel like our a cash flow figure, it's not off by a multiple of like 5x or 10x. This should roughly be in line with what the company is producing. I'm at a huge, I don't know, this has not happened out of the, let's call it like 10 or so DCFs I built, where what I built has been off by this order of magnitude. I think for me personally, I definitely have to look at this more. Maybe like as you guys in the comments down below, if you're looking at this when I'm not streaming on a future date, you notice I did something completely wrong, please let me know in the comments so that, I'll add as a pinned comment. I'll let you guys know what I did wrong, if anything at all. But unless some of my figures here are really off, it just seems like Costco is pretty overvalued, and I wouldn't touch the stock for now. And it kind of have to come all the way back to 100. Yeah, you know what I'll do is, because as of right now, I don't think I could really figure this out, because these numbers kind of just make sense to me based on what I've done. But I'll look into this, look into like some equity research reports or something, take a look to see if I've done anything wrong. And down in my pinned comment, I will let you guys know if I messed up somewhere. And if I did, then I'll make a follow-up video that fixes what I did wrong, to see if we get closer to this current share price. But as of now, I would say that I would stay away from Costco stock. I don't even think that, based on the free cash flow figure we have here, like, company is not really generating that much in free cash flow. So it doesn't seem like it should be trading at the $222 billion market cap that it currently is at. So let me check one last thing. This is also surprising because I was kind of bullish on Costco before I was doing all this. Okay, so cash flow from operating activities around 9 billion or so. Subtract out your capex. Yeah, then we'll get to roughly 6 billion or so. 5 billion. Approximation. I guess our cash flow figures are a little bit low here. I mean, what I'm seeing is that our capex figure is pretty high, and then our DNA is pretty low. So that is one of the odd things that I'm seeing. This is odd. It's also based on the street. Okay. Right. Even our most optimistic figures, and if we have our WACC closer, right now the WACC's really high because the 10-year treasury yield has shot up and everything. But if we were to go closer to what FactSet had, around 6.8%, this does get us closer to our current share price of $501. So, but still, it still shows to me that Costco is probably overpriced. But yeah, I don't know. I'm left pretty confused, to be honest, as you could probably hear from my voice. What I think is that regardless of what I do, probably it's going to seem like Costco is overpriced. So that's kind of like where I'll leave things. As I said, I'll make a follow-up video in the future just in case like I find something. I'll do some more research for all this. So yeah, that concludes the stream. Hope this video was interesting / helpful. Friendly reminder to check out moomoo if you want up to 15 free stocks. It's pretty much the most I've seen from any company kind of give away for free. So check that out down in my description as well. And I also am selling some resources that I created for getting into investment banking, and you could like buy my resume and cover letter and stuff like that. So feel free to check that out in my description. And yeah, hope to catch you all in the next video. Thanks all, and peace out.